Variable costing. Only those manufacturing costs that vary with output are treated as product costs. Absorption costing treats all manufacturing costs as product costs, regardless of whether they are variable or fixed.
A major difference between absorption and variable costing is how they handle costs and how they are treated on the balance sheet. On the balance sheet, variable costs include raw materials, direct labor, and manufacturing that's variable overhead. Absorption costing includes those and also takes into account fixed manufacturing overhead. In absorption costing, fixed costs do not flow onto the income statement until they are sold.
Let's look at an example. Here we are going to be determining the costs using each method. As you can see, we've set up prices, and direct materials is $6 per unit, direct labor is $5 per unit, variable manufacturing overhead is $1 per unit, and fixed manufacturing overhead is $20,000 per year. 5,000 units are sold per year. As we can see, the absorption and variable costing, they both take into account direct materials, direct labor, and variable manufacturing overhead. However, with absorption costing, it also takes into account fixed manufacturing overhead. How we determine this price is $20,000, which is the fixed manufacturing overhead per year, and the 5,000 units sold. This will give us $4, and we add that into the total price of our product.
When it comes to the income statement, under variable costing, expenses like manufacturing overhead are listed under the fixed expenses category. In absorption costing, this is quite different, as items such as manufacturing overhead costs are treated as a cost of the goods sold. This means that manufacturing overhead is distributed per unit and is not taken into account until the good itself is sold. It's really important to have an accurate sales number or sales projection number when using absorption costing so that you can properly and accurately budget for the cost of a project. For upfront budgeting and fundraising, variable costing will give you a much more accurate upfront estimate. To give you an idea of how this works on the income statement, here's absorption costing. It would be sales minus the cost of goods sold, which in this instance would factor in the manufacturing overhead. And remember, this was a fixed expense under variable costing.
Variable costing pros and cons. Some of the pros of variable costing are that it accurately identifies the variable cost of making one more unit. It also allows you to see on your income statement the total fixed manufacturing overhead that you would need to cover to make your business profitable. It is also a more straightforward costing system. The downside of variable costing is that all of your manufacturing overhead flows immediately onto your income statement and is treated as a period cost where it is paid each period. Absorption costing, the pros and cons. Some of the pros of absorption costing are that it allows you to disperse fixed manufacturing overhead directly into your product costs. It also allows you to pay manufacturing overhead over time as it is linked to product sales. Some of the downsides are that the amount of manufacturing overhead is dispersed as inventory is sold, which can make net operating income look higher than it actually is. Also, it can be confusing to understand for managers if they do not have an accurate portrayal of sales.